Good evening, everyone. Once again, welcome back to our revision classes for a very important paper, that is indirect tax law, which comprises of the customs law and the entire GST law. So students, we had our previous discussion in our previous class on Monday, where we discussed 3 different topics, all of great relevance to your exam. Now today, we are going to go to the most critical topic when it comes to the paper of GST. This topic is the topic relating to input tax credit. Again, if anybody of you have a very specific query, any specific section where you want me to put more stress, please inform me prior so that I can keep that in mind while covering my entire deliberation. So if you have anything in particular, also if by chance you have something relating to previous topic, which maybe at that time did not appeal to you, but later on while studying you found it challenging, you may put across that also. So I give you 2 minutes in case there is something which you feel we want to discuss, we need to analyze, you let me know, we can discuss that and then we can go ahead with this entire topic. Nothing from your side, students? Okay. So then let me start from my side. So very good evening, Mukesh, Debrata, Resham, Neha. Welcome all of you all. Let us start our today's discussion on this very important chapter of your syllabus. So we are on the topic of input tax credit. We all know input tax credit is the most important lifeline, I would say. Normally, I refer this as the soul of GST because whenever you study about the features and attributes of GST, out of the 3 most important features, one of the features is input tax credit. Let us understand this. So basically, GST is designed on the principles of VAT, that is value addition tax. When I say value addition, what it means is you need not pay the complete tax on your sale value to the government. I repeat, you need not pay the total tax that you have computed on the sale value. Though this is the tax which you show in your invoice, though this is the tax which you collect from your customer, you need not pay that to the government. Why? Because at the time of purchases, you would have paid some tax. That tax is given to you as a benefit, and this benefit can be encashed. This benefit can be utilized to settle the output tax which you are supposed to pay to the government. So since this amount goes to reduce your liability, that is why it is a benefit for you. Interestingly, it is called as input tax credit. Why? Why not debit or why not anything else? The main reason is, as we prepare our books of accounts, in our books of accounts, what is the journal entry? When I make purchases, let us say 100 rupees is the basic value, 12 rupees is the GST component. For the time being, I'm assuming IGST, and total you have to pay to the supplier 112. So the journal entry that is passed in your books is purchases debit 100, GST credit, which is of IGST. So IGST credit available 12 to supplier 112. Now, this amount in your books is a debit balance. Still, we call it as input tax credit. Why? Because when you look at the same thing in the books of government, which is the GST portal, where this particular amount is appearing in the GST credit ledger. We call it as the e-credit ledger or the electronic credit ledger. In that, this is appearing as a credit balance. So the basic ideology is, we have seen this even in standard 11 when we studied BRS, that when the same transaction is reported in both parties' books, my book and the banking or the banker's books, What I am debiting is what is credited in the banker's books in my account. Similarly, when I am showing input tax credit as my asset, a debit balance in the books of the governments, which is reflected in your GST portal, it is appearing as your credit balance. And that is why the law has given the terminology credit. Fine. Okay. Now, when we talk about this chapter, broadly three things are what is to be understood, studied in this chapter. One, when you are eligible to get the credit, which is detailed out in section 16 via different conditions. Then when this credit will not be allowed to you either completely or partly, which is detailed out in section 17. And when the credit would be allowed or would be required to be reversed under some special circumstances, which is detailed out in section 18. Besides that, we have some special scenarios of job work. We have some special scenario of input service distributor. All these things is what is the basic syllabus of this entire chapter and topic. Fine. So with this, let me start with this deliberation. If anybody has to emphasize on something, you want me to stress on something, please inform me there and there itself so that that point would be deliberated in detail. So I will start with the, let us recapitulate part first. So we cover all the key points in short, which will be relevant, which will be helpful for your exam. So firstly, the definition of business is given, which I'm sure you would have covered in your first lecture, which deals with the initial chapters. Now, for the purpose of this chapter, the relevant definitions are, first is the definition of exempt supply. I'm sure you would have studied this earlier also, but here I will just reiterate because it is very relevant for this particular chapter. Now, in exempt supply, the law covers broadly two types of supplies. First, or I'll say three types of supplies. First, the supply which is attracting nil rate of tax. So where the tax rate given in the rate schedule itself is zero, is what is the first type of exempt supply. Now remember one thing, students, there is a concept in GST called as zero rated supply. Zero rated and nil rate are two different concepts. Please do not mix them. They represent two different types of supplies and transactions. So here we are not covering zero rated in exempt supply. In fact, zero rated is covered in the taxable supply. So what is covered over here is that supply of which the rate given in the rate schedule is nil. So you call it as nil rated but not zero rated. Second, the supply which is having some rate given in the rate schedule, maybe 5, 12, 18, 28, whatever, but by way of a specific exemption, that amount is fully exempt. This is very important. Exemption can also be part. You may be given 50% exemption, 60% exemption. That will not be considered as exempt supply for the purpose of the definition and the other provisions. Only, where your entire tax, whatever rate is given in the rate schedule, that entire tax is exempted. Only then, only there, the supply would be called as exempt supply. And then the third category, which is included in exempt supply, is non-taxable supplies. Now, what is non-taxable supplies? Here, again, I would like you all to be very specific because in exams, these are the minute things which will create a difference. There is something called as a no supply transaction also. Now, we all know what is a no supply transaction. You have schedule 3, which gives you a list of those transactions which the law does not want to consider as a supply. So we call it as no supply transaction. Further, Section 7 of the GST Act, CGST Act, gives you certain conditions to be satisfied so that your supply would be called as a supply or your transaction would qualify as a supply. In case you do not satisfy any one of the condition, still your transaction is not a supply. So there is a concept, there is a category of transaction which we can say that these are no supply transactions. Now, mind this point, students. When we are talking about exempt supply, the word itself or the heading itself has the word supply. So in order that you treat anything as exempt, it firstly has to be a supply. If something is no supply, either because it is fitting in Schedule 3 or either because it is not satisfying the conditions of Section 7, whatever could be the reason, if that transaction is a no supply transaction, it will not be considered as exempt supply. So this is very, very relevant for your exams, because in the exams, as we proceed further, you'll understand the relevance of this term in this chapter. So wherever there are questions relating to the provisions where exempt supply is to be used, is to be applied, at that stage, you will require or you will have to pay attention to what I just explained. So no supply transactions will not be treated as exempt supply. In fact, it is not treated anywhere in the entire GST law. So entire GST law can be divided into three types of supplies. One is a taxable supply, one is an exempt supply, and one is a no supply. Taxable and exempt together makes up the turnover for the purpose of GST for all calculations wherever turnover is required. No supply transaction will not form part of turnover and will not form part of any calculation in the GST law. So be clear with this. And there is a difference between what is a non-taxable supply and what is a no supply. So no supply is different transaction. Non-taxable supply is a different transaction. Now you'll ask me, sir, what is a non-taxable supply? So a non-taxable supply is that supply. Pay attention. Non-taxable supply is that supply for which there is no levy of GST. So we have those 5 petroleum products as on date. We have the alcoholic liquor for human consumption. These are those transactions which are not leviable to GST. If they are not leviable to GST, they become non-taxable. But since whatever transaction you do of these commodities, whether you sell it or you give it in the form of anything which is provided in Section 7, so it will become supply. So you do any transaction which fits in the definition of Section 7, because these are goods. You do one of the forms of supply in the form of sale. There is a consideration, it is your business. So all conditions of Section 7 are satisfied. So it is a supply. But since it is not leviable to GST, hence it becomes a non-taxable supply. Non-taxable supply is also covered in exempt supply. So be clear, no supply is not exempt supply. Am I clear? But having said this, let me give you a caveat. Let me give you an exception. What is that exception? Even though what I'm explaining to you here, I just elaborated, in fact, emphasize on this point, ki what is no supply will not be covered in exempt supply. Correct? However, when we go to the actual usage of this term, that is exempt supply, in this chapter of ITC, you will realize that in that part, that is Section 17.2, read with Section 17.3, where this exempt supply is used in this chapter, they have purposefully included few transactions from Schedule 3 in the concept of exempt supply. Again, they have included few more transactions from what is not a supply. Why? Because it is not satisfying the conditions of 7. What is not a supply, they have included few such transactions also in exempt supply. So I just elaborated, emphasized that what is Schedule 3, what is not satisfying Section 7, these two are no supply transactions and they do not form part of exempt supply. Correct? That is for the purpose of exempt supply definition for the whole act. However, when we go to this particular concept where it is used in Section 17.2, read with Section 17.3 in this chapter, there you will find that only for the limited purpose of this chapter and Section 72, 17.3, they have asked you to consider few transactions from Schedule 3 and from no supply category. Why? Because they are not satisfying section 7 conditions, to include them in exempt supply only for the purpose of 17(2) calculations. So be clear with this. Within the law, there is some variation given to this concept of exempt supply. Please be very clear, students, because this point is having lot of relevance in exam. So right now, when we are discussing this chapter, I will be emphasizing more on those concepts where, thank you. Thank you. नहीं, वो बाहर गए. Thank you. Sorry. So, students, we will be emphasizing more on those concepts which have relevance to exams. So please be very pinpointed on those points. I hope this concept of exempt supply is thorough to everyone because it has lot of importance in your exams when it comes to this chapter, especially. Fine. Any other definition of goods and service? I'm not going into that. You would have understood this in length. Now we come to the most important definition, which is relevant to this chapter as to what is input tax credit, though it is not there on your screen. They have defined it simply to mean credit of input tax. So something which is credited in your name and it is of input tax, that is what is input tax credit. So now the question becomes, what is then input tax? Because this is what is the tax which when credited to your credit ledger, it will be called as input tax credit. When it will be credited, when you satisfy section 16 and you are not falling in section 17 restrictions, then it will be credited. Now, for the purpose of this, what is the meaning of input tax? The answer is very simple. Any tax which is a GST, which may be CGST, SGST, UTGST, IGST, that will be input tax. Again, it may be payable under forward charge, or it may be paid by you yourself under reverse charge, or it may be paid by you on import of goods at the time of import to the customs authority. All this, since it is a GST tax, will be input tax. However, interestingly, now since you are at final, we can discuss this. You also know that there is one more tax relating to GST, which is called as the compensation cess. This is the short form. Have they included compensation cess in the definition of input tax? The answer is no. But then is it not a GST tax? Yes. Then why have they not included it? Do we not get the credit of compensation cess as input tax credit? The answer is yes, no, both. Now, what is yes, no, both? So firstly, compensation cess is also part of GST. However, it is not allowed as credit in CGST Act, SGST Act, UTGST Act, IGST Act. But it is allowed as credit in the Compensation to States Cess Act, that is the Compensation Cess Act. Why so? Because there is a restriction that credit of compensation cess can be used to set off compensation cess liability only. It means compensation cess output liability and compensation cess input credit, only these are set offable. There is no cross set off allowed that on input side you have CGST, SGST, IGST, output side you have cess, you can set off. No. Vice versa also not allowed. You have cess in the credit and in the output you have CSI liability. Can you set off? Answer is no. So the set off of cess is restricted. It is allowed, but it is restricted only to the compensation cess liability. It cannot be set off against the regular GST taxes. Hence, in these acts, see, we discussed this in the previous class also. What we are studying is exclusively CGST Act. Obviously, we are presuming the same thing is in the respective state acts. And we are also discussing at relevant places IGST Act. The cess is nowhere included in these acts when it comes to set off. So it is not covered in the input tax definition. So firstly, all GST taxes are included, whether paid under forward or reverse, that makes no difference. But cess is not included, though it is input credit and it is eligible for set off in the cess act. Second thing, if a composition dealer is selling to you or you are purchasing from a composition dealer, we know that the composition dealer has paid some tax under the composition scheme, be it 1%, be it 6%, 5%, whatever. That is also a GST tax, or it is an amount equivalent to the GST, but it is also not eligible as set off to you. So if you are buying from a composition dealer, whatever tax the composition dealer is paying, you cannot take set off of that tax. So that is also not part of your input tax definition. Then you have the definition of CTP, NRTP. CTP is casual taxable person, NRTP is non-resident taxable person. Both are similar. CTP is applicable when, let us say, I'm registered in Maharashtra. I come to Noida because there is an exhibition, where I want to participate by putting the stall of my business and display my goods and sell it from there. Then, since I am making a supply from UP, though not permanently because I'm not having any permanent place of business or fixed establishment, but for a temporary period, the law requires me to register there for a temporary period. This temporary period registration is CTP, casual taxable person. Similarly, if I'm a non-resident and I am also coming to India for participating in the same exhibition by putting my stall, displaying my goods, selling my goods from there, again, I am not having a permanent business establishment in India. I am coming to India and again, I will be doing some sales, some supply from UP state, from that exhibition place, but that will be for a temporary period. So again, the registration which I take for the temporary period, I being a non-resident person will be called as NRTP, non-resident taxable person. Then comes the next definition of inward supply, which is simple. So whatever is coming into your business, whether you are purchasing it, whether you are acquiring it, whatever is the inward supply to your business of goods or service, they are called as inward supplies. I mentioned at the start that there is a difference between nil rated and zero rated. Zero rated, in fact, is a taxable supply, and nil rated, as we studied, is an exempt supply. What is covered in zero rated? Broadly, two types of supplies are covered. When you are exporting your goods or service outside India, that is the first category of supply, which is zero rated. Second, when you are supplying your goods or service to a SEZ developer or any unit which is in SEZ, again that supply is zero rated. So your supply to SEZ or your supply outside India, these two are zero rated supplies. And they are treated as taxable supplies. Now, besides this, there are three more definitions not covered here. So let me take it from the main part of the module. So some more important definitions, which I believe you should know. Input service distributor is important, but we'll come to this later on. So you get input credit of three things. One is input service, then inputs, and then capital goods. Now, what are these three things? So firstly, what is input service? It means any service which is your inward service and which you are purchasing with the intention of using it in the course or furtherance of business. So how for outward supply, we have this condition that what will be a supply? When you are making any outward transaction of sale, barter, etc., in the course of your business, that will be a supply, outward supply. Similarly, what will be inward supply? What will be input service? It means whatever services you are getting into business with the intention of using it in the course of business. Similarly, similar to this definition is definition of input. What will be input? It would mean any goods which you are not capitalizing in your books, because whatever you capitalize in your books is called as capital goods. Now, whatever you are not capitalizing in your books will be called as inputs, again with the same requirement that you have acquired it with the intention of using it in the course or furtherance of business. That's it. Baki output tax we know, outward supply we know. These are regular definitions. So I'm not going on to these definitions. Fine. See, some more definitions relevant, but that will come to when it is required. Now we come to the first major section, which entitles you to take input tax credit. It is section 16. So section 16, I generally refer this to as the mother section, which means that like mother, this section is very kind to allow you the credit of certain taxes which you have paid on your inward supplies. But in order that you are taking or getting this benefit, you have to satisfy some conditions. First is the eligibility condition. Now, what is the eligibility condition? The eligibility is you should be a registered person. First thing. So until and unless you have taken registration, until and unless you are registered, you are not eligible to take the input tax credit. So for getting the credit or taking the credit, the first eligibility is you should be a registered person. Now, second eligibility requirement is the inward supplies for which you want to take this ITC. Those supplies are either used or intended to be used in the course or furtherance of business. It means it should be your business inward supplies. If those supplies has no connection with your business, again, you will not be eligible to get the ITC. So these are the two eligibility criteria. Now we come to the conditions which you have to satisfy. The first condition is, in order that you are allowed the ITC, you should have a proper document which represents that yes, genuinely you have done this purchases of these goods or service or capital goods, whatever it is. Now, what is this document? Either it has to be a proper tax invoice, it has to be a debit note related to some invoice, or it can be any other prescribed tax paying document. Now, what could be these other prescribed tax paying documents? Like in case of import, at the time of import, when you're importing, you have to clear your goods by filing bill of entry and paying tax through the TR6 channel. So again, that becomes a tax paying document. Similarly, what could be the other prescribed documents? When you are paying tax as a recipient on your inward supplies. In such a case, it happens that many times your supplier is an unregistered supplier. Now, when your supplier is an unregistered supplier, he or she will not be giving you any valid tax invoice. Why? Because the supplier is unregistered. Now, if the supplier is not giving you a valid tax invoice, for the purpose of complying this condition, you are required to self-create an invoice. What is self-create an invoice? You are required to issue an invoice by yourself to yourself. So you are raising invoice on yourself, which is also called as self-invoice. Again, this is eligible for ITC as one of the valid documents. Another valid document for getting ITC is when your head office or your office, which is registered as ISD, Input Service Distributor, if that head office receives some common input services, which it is now distributing to you. How it will distribute? It will prepare its own invoice, which is called as the ISD invoice. We are going to study this at the end of this chapter where the details are given in section 20. So when your head office or any office which is registered as ISD is distributing the credit of common input services, again, the law has prescribed that the ISD has to prepare an ISD invoice through which it can distribute. So for you, the valid tax paying document is this ISD invoice. Perfect. So these are the various valid documents which entitles you to get the ITC. I hope I'm clear with this. Now, second requirement, very important. This requirement is that you will get the ITC only when this ITC is appearing in your portal in the GSTR 2B summary. Now, what is this GSTR to be summary? You can call it your purchase summary. But this purchase summary is created when your suppliers, vendors have filed their GSTR1 return. In their GSTR1 return, or if they are using the IFF, invoice furnishing facility, and they have submitted or uploaded the documents, the invoices. So when they file their GSTR1, in which they show the invoice which represents sales to you, which represents supply to you. So your purchase invoice, their sale invoice, when they upload the sale invoice in their GSTR1 return within the prescribed time limit of filing GSTR1 of every month, that reflects in your purchase summary, which is GSTR2B. If they have not filed the invoice, or they have filed the GSTR1 late, or if they file but show wrong details because of which it is not reflecting in your 2B, this second condition is not satisfied. And even though it is your valid purchase for this month, you cannot legitimately take the credit in this month. So this second condition requires your supplier to upload his invoice relating to your transaction in the GSTR1 return correctly within the specified time of GSTR1. Third condition. Now this condition has been slightly, you can say, modified, has been pacified by introducing one more section. But for the time being, in section 16(2)(c), the condition is that you will get credit only when your supplier has paid the tax. It means if your supplier fails to pay the tax, or if your supplier has missed to pay the tax, you will not get the credit. This is what this condition is. However, this condition has a relaxation. It is not there here. So you can just make a note of this. There is another parallel section, section 41, read with rule 37A. Now, what does this section 41 read with rule 37A says? So first, see, the basic condition put in 16(2)(c) is that we will allow you credit only when your supplier has paid the tax pertaining to this invoice which the supplier has given to you. This condition has been pacified by section 41, read with rule 37. How? It says that, let us say we are talking about the current month of May. So I have made purchases from you. You were supposed to file this particular return or this particular invoice. You are supposed to upload in your GSTR1 return of May, which you are going to submit in the month of June, which you have done. But in the 3B return, through which you are supposed to discharge this tax, you have not filed, you have not discharged the tax. Now, when this happens, that you have not filed GSTR 3B, you have not discharged the tax through the GSTR 3B return, then I am informed by the GST portal that my supplier has not paid the tax. So whatever is appearing in my 2B, why it is appearing? Because you have uploaded it in GSTR1, it is appearing in my 2B. So second condition is satisfied. Still, I will not be eligible to take ITC because this third condition is not getting satisfied. Now, the effect of this section 16(2)(c) read with 41 and rule 37B is what? 37A, sorry. It says that section 41 says that if your supplier has not paid tax, this condition requires that you will not get paid fine. But 41 has slightly pacified it. It says that you take the credit temporarily, you take it provisionally, and you start taking follow-up of your supplier, asking the supplier to pay this tax. So 41 has slightly pacified this by saying that you need not reverse your credit immediately. When 41 was not there, when rule 37A was not there, and only this condition was there, the interpretation was that if I have taken credit now and my supplier is not paying tax in the next month when he has to file the returns, I am supposed to reverse my credit immediately in the next month when I come to know that he has not paid tax. Otherwise, I'll be liable to interest penalty, etc. Now, if my supplier is not paying tax now, means after introduction of section 41 and 37A rule, I am not required to reverse the credit immediately. These new provisions say that I only need to make follow-up with my supplier constantly, asking him, requesting him to pay the tax. This financial year is financial year 25-26. My purchases are in May 25, pertaining to financial year 25-26, which will end on 31st March 26 next year. Now, what I'm asked to do is I am required to make follow-up with my supplier, and I have to try to ensure that my supplier files his 3B and pays the tax latest by 30th of September 26, that is in the next year. If he does so, anytime from today till the next year's 30th September 26, if he files this 3B returns and pays the tax, I have satisfied this condition because supplier has paid the tax, no need of any reversal. But if up to 30th September also my supplier does not pay the tax and files his 3B return, then this section read with the new 41 section and rule 37A requires me to reverse this credit because I've already taken the credit. I need to reverse it maximum by the October month's return, which I will be filing. So 30th September time is for the supplier to file 3B, pay this tax. If it does so, my responsibility over, I have to do nothing, no reversal, no interest, nothing. If it does not do that, then I am allowed my time up to the date, which is 30th of November, sorry, not October return, 30th of November, that is further 2 months, by which I need to reverse my ITC. If I do that, no interest, nothing. And in future, whenever my supplier pays the tax, I can take the credit. This is what 37A says. However, if I also fail to reverse it up to 30th of November, then my interest would trigger beyond. So this is what is the new provision under section 41 read with 37A applicable to this condition that the supplier should have paid the tax. This is clear to all students? Anybody having any particular questions, doubts in this, you may please ask, because it is slightly tricky involving 2-3 provisions at the same time. So if you have any questions, you may put it across.
Excuse me, sir.
Yes, beta.
Earlier, when we take the input and the supplier doesn't pay the tax, we have to reverse that.
Okay, correct. But not immediately because of this new section. Go ahead.
This new section is applies from when?
If I'm not wrong, but it was introduced. Now it is in 2022 itself, if I'm not wrong. I don't recall. Let's see. The timeline would be given here. But if I'm not wrong, it was.
In the question, we have to check this or
No, don't worry, but in question, see, because the question will be pertaining to the latest period, right? It won't be dating back to 22 or 23 something. It will be of the present period. So that is why I'm not going on that detail. Even see, it is not mentioned here even in our entire module. Reason is now that is not required. They will not test you on the timeline, correct?
Okay, sir.
Otherwise, see, what if it that whatever wherever timeline is relevant, I will mention that. So now, since this rule is there for last 2 to 3 years, so don't worry, it will be applicable for all the exam questions as it is without the timeline consideration.
Okay, sir. Thank you.
Yeah. Any further questions, students? Okay, let me proceed then. So relevant to this condition, the additional condition or the relaxation is that even if my supplier deposits this up to next year's 30th September, I am fine with this condition. No interest payment, no reversal required. Fine. Then we come to the next requirement, the next condition, that I should have actually received the goods or service. Now, what this received means is, let us say I have placed order and you have dispatched the goods, but the goods did not land in my premises by 31st of May. Even though this transaction pertains to 31st of May, if my goods have not landed physically in my premises by 31st of May, or if I have not taken the delivery or control of these goods from you by 31st of May, then this condition will not allow me to take the credit. It will restrict me from taking the credit. So as per this condition, the credit will be eligible only if I have actually received the goods or services. Now there are two relaxations to this. First relaxation, as you can see over here, is that when it is a bill to ship to model. What is a bill to ship to model? I have placed order on you. Let us say I have placed order on Neha, asking her to deliver the goods to Resham. So I am placing order on Neha, who is my supplier. I am the buyer, but I have asked Neha that this delivery I do not want at my place. I want this at Resham's place. Now in this particular case, this transaction involves three persons. Supplier is Neha, buyer is Vishal Poddar, and the ship to or the delivery person is Resham, where the goods are supposed to be dispatched or delivered. Here, the transaction is termed as a bill to ship to model transaction, where there are three parties involved. And in this particular case, interestingly, these goods will never come to me physically. They will never come to my premises, because the model of the transaction itself is such that the goods have to be dispatched at a third person's place. Now, in this particular case, literally, I am not satisfying this condition. However, go back to your contract act concepts. Over there, we had the concept of constructive proposal, constructive acceptance, deemed acceptance. Similar logic is over here. Here we have a concept of constructive receipt of goods. What is this constructive receipt of goods and even constructive receipt of service? Which means that even though physically I am not receiving the goods or service, but if on my behalf, if the goods or service are delivered to another person, and obviously on my behalf, on my specific instructions, so when these goods reach there or they get the delivery of these goods or service, it will be equivalent to me getting the goods or service delivery, and it will be the full satisfaction of this condition. So when this condition requires that the goods or service should have been received, it may be received by me, or it may be received by a third person on my behalf, on my instructions, which is called as the bill to ship to model. Again, relevant to this is one more point, that is this, where these goods are received in lots. Now, it may happen that I have ordered a machinery which is such huge in size or in its length or in the weight that it cannot be transported in one truck in one whole shape. It has to be made parts, which is called as SKD or CKD. SKD is semi-knockdown, CKD is complete knockdown. So that machinery has to be broken into smaller parts, and then each truck will be carrying one part, one small assignment of the total machinery, one lot of that total machinery. This happens generally in case of huge machinery items, in case of windmills, in case of some towers, etc. So all these are practical examples. Now, when I'm buying one single machine from you, you are giving me one single invoice, but the goods are coming to me in multiple trucks, small parts or lots loaded in every truck. So let us say there are total 12 trucks in which the entire machinery is loaded and they are coming to me. Now, by the end of this month, out of 12, 10 have reached my premises. 2 are still in transit, and they may be reaching me on 2nd June, the 11th truck, and the 12th truck is reaching to me on the 7th June. Now, in this particular case, I have one invoice representing the whole machinery, but the goods are coming in 12 lots, 12 trucks. The law requires or puts a condition through this proviso that where the goods are being received in lots, I will be getting the credit of the entire machine only when the last truck reaches my godown. So until I receive all the trucks, I will not be able to get the crate in. So in my example, even if 10 trucks have reached me, you cannot take proportionate crate of 10 trucks. You'll have to wait for the remaining 2 trucks to come. And once those 2 trucks reach your godown, it reaches you, only then you are eligible to take crate of that entire machine. This is what is the impact of this condition. Then comes another condition which today practically I will say has no relevance. This
Sir,
is very sorry.
excuse me, sir.
Yes, beta.
Sir, in this case, bill to ship case, if one party delivers goods on my behalf to the third party,
Yes.
and what is the requirement of the tax invoice which I have to raise to the third party, the time limit, or the I have to raise the invoice immediately, or is there any time limit?
See, beta, it depends upon whether it is supply of goods or service. If it is supply of goods, you already have studied in time of supply chapter that the invoice has to be raised immediately upon dispatch, delivery, removal. Correct? But if
Yes.
it is supply of service, then you have 30 days window.
No,
So
sir.
that depends. Okay.
I'm asking about that. If I haven't received the invoice immediately, and I've received the invoice after 2-3 days of removal of goods, then what should happen?
You are talking from which perspective? You are talking from ITC perspective. You are talking from supplier's perspective, time of supply
ITC
perspective.
purpose.
So, beta, then this point is very clear. Na? Then you are first looking at this first condition itself. So the condition is until and unless you have the tax invoice, you cannot take the credit. So if let us say supplier is giving you tax invoice late, he is not following the time of supply provision. So that is a different matter. He has to pay the penalty for not complying with the time of supply. That is a different matter. But from your end, recipient's end, since you have not received the tax invoice, you are not fulfilling one of these conditions. So you are not eligible for credit. You will be eligible only when all these conditions are satisfied. So only after you have received the invoice, then only you will be eligible for the credit.
Oh,
I hope
okay,
I've
sir.
answered you.
Okay, sir.
Fine, beta?
Yes, sir. Thank you.
Moving ahead. Now I was talking about this condition. Now this condition is recently introduced, added in this section. However, this condition presently has no application. Now what does this condition says? This is a negative condition, negatively drafted condition, which says that even if you satisfy all the other conditions, still your ITC will not be available until and unless 38 allows, or negatively, your ITC will not be allowed if 38 restricts. Now, what is this section 38? 38 is a newly introduced section which has put some additional conditions, some additional requirements for availing this ITC. So firstly, the new condition added relevant to this 38 is this, the 38 section is this, which says that details of input credit in respect of the said supply communicated to such registered person under 38 has not been restricted. So the condition is negatively put, which says that 38 should not restrict your credit. Now, what is 38 saying? "38 has listed out these certain scenarios. In these scenarios, section 38 says that we will not allow you credit. However, as I said, this condition is not effective today. How it is not effective, let us understand. But for your academic purposes, you should know section 38 condition. So there are two parts in 38. Firstly, section 38 says the first requirement is that your supplier has uploaded your invoice in his GSTR1 or using the IFF, and it is auto-populating in your GSTR2B of that particular month. This is anyways repetitive condition of what was given above, but further it says that this particular amount which is auto populated in your GSTR 2B, that is your purchase summary, that should not be, I repeat, pay attention, that should not be shown as not available in 2B. So when you see the 2B returns on the portal, in the 2B returns, there is a column where it says ITC available or it says ITC not available. So if this 2B, which you can see on your portal, is saying ITC not available, then this section 38 comes into picture, and section 38 says you will not be eligible to take the credit. So the first restriction put by section 38 is that the credit appearing in your 2B should not say that it is not available. If it is saying it is not available, then it can be a problem. And then this section 38 puts you into certain requirements, or I'll say certain restrictions, where your credit will not be allowed. But these restrictions are not effective today, but I'll explain you for the purpose of academics, because this may be relevant in exams. What it says, that if you have purchased these goods from such a supplier who is newly registered, so he has very recently taken registration, and you are purchasing the goods from such a supplier, then GSTR 2B, that is your purchase summary, which is auto-populated, may say that the credit is not available. Now, why I said that this section 38 is not effective today, or at least this part of 38 is not effective today, because here further in the section itself, they say that up to what time that person has taken registration, so that we call them as a new registrant, will be prescribed. Prescribed means you will get rules, where in the rules they will say that section 38 will trigger when the person is newly registered for 2 months, 3 months, 5 months, 6 months, something they will come up with. They have not yet come up with anything. Since they have not yet come up with the prescription as to till what period a newly registered person's, a newly registered supplier would fall in this restriction of 38, till they do not prescribe this time limit, technically this section is only academic. It has no practical application. Similarly, the second restriction where 38 says that your credit may not be available is where your supplier has defaulted in payment of tax. Again, 1 month default, 2 months default, they say again for how much period he has defaulted, we will prescribe. Nothing is prescribed today. Thirdly, it says that where your supplier is such that your supplier's output tax, which he has shown in his GSTR 1, is exceeding the output tax which he is showing in his GSTR 3B. And this is exceeding by a particular amount or percentage. Again, how much amount, how much percentage, and for what continuous period this is exceeding, they say this will be prescribed. Again, nothing is prescribed. So technically, this is also not applicable or effective. Third, it says if you have purchased goods from such a supplier who has taken his ITC, whatever he has taken, and whatever ITC he has taken is excess from what? From what is appearing in his 2B. So he is taking ITC more than what is appearing in his 2B returns, then also we will disallow your credit. And finally, where your supplier has defaulted in paying his tax liability as per section 49(2) read with 86(b). In other words, the supplier has not complied with the 86(b) condition and has utilized the credit ledger beyond what is allowed in 86(b), then also we will disallow your credit. So if you see all these you can say restrictions are connected to what your supplier has done. So even if your supplier has done one of these defaults, you will be disallowed the credit under section 38 requirements. Fortunately for us, 38 is not yet made effective, because as you can see, for all these conditions, they are putting that this will be prescribed, this will be prescribed, this will be prescribed. But for the time being, nothing has been prescribed, so we are safe. I hope this is clear to all. So another condition which is as on date, you can say only academic, is that your ITC should not be restricted by the conditions of section 38. Fine. Next, you should have furnished your 3B return. Now, again, this is a very simple condition. See, we claim ITC through our 3B return only, because our GSTR1 return which we are filing is only showing our outward supply. There is no return to show our inward supply, or for us to claim our ITC. We directly claim our ITC or show our ITC in our 3B return. So logically, until unless you show the ITC, until unless you claim the ITC in your return, how will the government allow you that ITC? So by default, the condition is that you should have furnished your GSTR 3B return, that is a return provided in section 39. Then comes some more condition. Now this particular condition is dealing with ITC on capital goods. So let us say I purchase a machinery for 100 crores on which GST applicable is 18%. So it is 18 crores. I have paid 118 crores to my supplier. All above conditions are satisfied. There is no default, nothing. This 18 crores, which is my GST paid on the machinery, which is my capital goods, is available to me provided, pay attention, provided I am not capitalizing this 18 crores. That is, when I am capitalizing this machinery in my books, I should capitalize only 100 crores and not 118 crores. If I capitalize entire 118 crores, that is including this 18 crore, the GST component, then I cannot take the credit of this 18 crores GST component. So point is very logical. Either you take depreciation of the GST component by capitalizing it in your books, claim depreciation, get the benefit of income tax on that, or you don't claim depreciation, don't capitalize the GST component, then you can take the ITC. So this is a contra condition with the income tax law. And then the most important condition is the time limit condition, that wherever you want to avail this ITC, you avail this ITC how we just saw, by filing your 3B returns. Now, if we are talking about financial year 25-26, which is ongoing, this will end on 31st of March 2026. Now, I have my purchases from April to March. Either I should claim it in the respective month's return whenever I am filing, or I am allowed to claim it in any further return which I am filing. So let us say I have purchased something in the month of May 2025. I can claim the credit whenever I am filing my May 25 3B. However, if I miss to claim it in May 25, I can claim it in the 3B of June, July, August, anything. But there is a timeline which is 30th of November of next financial year. So for me, it is 30th of November 2026. So whatever is my ITC pertaining to the current financial year 25-26, this I can claim by filing my 3B returns, and this claim has to be done latest by 30th November next year, or whenever I am filing my annual return of this year, whichever is earlier. So I have to also file the annual consolidated return of all the months at after 31st of March. So now I am filing monthly returns. I have to consolidate all this and make one annual return, which is my GSTR 9 return. This return is full and final closure of this financial year from my side. So either the date of filing my annual return or 30th of November, whichever is earlier, till that date only I can claim ITC fresh. However, in whatever cases where I had already claimed and reversed the ITC and I want to reclaim, like we just saw, supplier did not pay tax, so I reverse it. Now I want to reclaim whenever he pays tax. Or there is that 180 days rule which we are going to discuss. If because of that I had reverse. So whenever I am reclaiming this reversed ITC, at that time, this time limit of 30th November will not apply. But for availing fresh ITC, the time limit of 30th November will apply. Then comes this 180 days condition. Now, what is this 180 days condition? The 180 days condition is that if I want to take ITC, I should have made payment of this particular supply to the respective vendor within 180 days. Means whenever I am buying any goods or I am taking any services and it is on a credit, that is, I don't pay immediately to my vendor, I can take the credit immediately if all the above conditions are satisfied. But then from the date of invoice, I am allowed 180 days to make payment. If I make the payment within 180 days, matter is closed. But if I fail to make the payment, then the law requires me to reverse that ITC again temporarily. And in future, whenever I will make payment to my supplier, I can re-avail the ITC. Now, if I make proportionate payment, this is also very important for the purpose of exam. It may happen that my invoice is of 1 crore. I am allowed credit, so I have not paid that amount. In future, within 180 days, I pay 70 lakhs. Still 30 lakhs is pending and 180 days have elapsed. Then whatever is the GST credit of this 1 crore, I will proportionate it and find out how much is proportionate for 30 lakhs, which is the amount which I have not paid up to 180 days. And then this proportionate credit, I will reverse. And in future, whenever I pay this, the payment to the supplier, I will re-avail. Now, there are two exceptions to this 180 days rule where I need not reverse. First, where the tax is paid by me under RCM. So for reverse charge cases where the tax is paid by me, that is the recipient, because my supplier is not paying the tax, I am paying the tax myself. This requirement of 180 days does not apply. Second, Schedule 1 supplies, which is also called as deemed supplies, where those supplies are triggered, or I'll say taxable, even without consideration. So even though there was no consideration, but Schedule 1 of the GST law consider it as a supply, deems it as a supply. In such a case also, 180 days rule is not applicable and I may not make any payment because anyways there is no consideration. So how will I make payment? Then interestingly, something related to valuation chapter. What is this valuation chapter? If you remember, in valuation we studied section 15(2)(b), where some of my liability is met by my recipient. So I had to pay off some of my liability, some of my creditor, my recipient directly paid it. Now, if my recipient has already paid something on my behalf to outsider, why will the recipient pay that amount to me again? Because he has already paid that amount to a third party on my behalf. So where the recipient makes such payment to a third party, obviously he or she will never make the payment to me again because that is already done. So again, whatever the recipient has paid on behalf of supplier will not be any time paid to the supplier, but that is the compliance of this condition that will be deemed, and hence there will be no reversal required. Is this fine? So these are the requirements of section 16. Let me just run through the main part. Perfect. See, let us go back. Now we come to the second part. The second part is section 17, where the law restricts or blocks my credit either fully or partly. Now, first part of section 17, which is contained in section 17(1) and 17(2), it says that for certain supplies or in case of certain business models, scenarios, you will not be given your full credit. Your credit would be proportionated. Now, what are these two cases? The first case, which is given in section 17(1), says where your supplies include business supplies and non-business supplies. So where you are not exclusively into business supplies, your supplies also have some personal transactions which are non-business supplies, then also your ITC cannot be allowed full, it has to be proportionate. Similarly, where you are engaged in making taxable supplies, which include zero rated, and also you are making exempt supplies. So your outward supplies has taxable component also, exempt component also. In such a case, you will again not be allowed full credit. In such cases, your ITC will be proportionated, but how? That is provided in Rule 4243, which we are going to discuss and understand separately. Further, it says you will be allowed ITC only of that portion which is applicable to business and within business which is applicable to taxable. So whatever is pertaining to non-business, whatever is pertaining to exempt, that will not be allowed. Now, here comes that variation in the concept of exempt supply. If you remember, I had explained we had a detailed deliberation at the start of today's session about what is exempt supply under GST, where I said nil rated, fully exempt, and those supplies which are supplies but which are for the time being not leviable to GST, that is non-taxable supply. These three are covered in exempt supply. And then I said schedule 3 items and which is not satisfying section 7. These two are no supply and they are not included in the definition of exempt supply. However, I also mentioned at that time immediately that only for the purpose of this chapter and this section, what we are discussing 17.2, few items from schedule 3, few items from what is not satisfying section 7 are specifically considered as exempt supply only for the limited purpose of this section 17.2. What are these supplies which are treated as exempt supplies only for this section? It says exempt supplies over here, that is for this reversal, will include reverse charge supplies. Notice this reverse charge supplies. I am a supplier of GTA service where I am given an option that I may pay the tax under forward charge myself or I may shift the responsibility to you and ask you to pay tax under reverse charge. Let us say I go for the second option. So in my case, whatever supplies I have made of this GTA service where the tax is paid by you, the recipient under RCM, for me, such outward supplies will not be considered as taxable, or in other words, will be considered as exempt. If you see the intent of the lawmakers, it is very clear that since you are not going to pay any tax on it, somebody else is going to pay tax. So at least from your perspective, since you're not going to pay any tax, let us consider it as exempt. So this is where I think the lawmakers have considered this in the exempt supplies, but this is only for the limited purpose of this section. Further, what it says, what else is covered? Transaction in securities. Now, if you know, securities are neither goods nor service. So whenever somebody is buying, selling securities, that is share, debentures, mutual fund units, etc., it is no supply because it is not fulfilling the condition of section 7. Which condition? That there should be goods, service, both. It is not there in case of securities. However, the law has specifically in this particular case asked you to consider it as exempt supply only for this reversal section. Further, it says, so what is exempt supply? It includes reverse charge supplies, it includes transaction in securities, but it will exclude, what it will exclude? Those transactions which are specified in Schedule 3. So this also had explained that Schedule 3 is a no supply transaction list, and what is no supply can also not be exempt supply. So Schedule 3 is not considered as part of exempt supply. However, they have then carved out few transactions from Schedule 3 and asked you to consider them as exempt supplies. What are these? Sale of land, sale of completed building whose consideration is received after the completion certificate or the first occupation. So this is the first transaction from Schedule 3 which is not considered as part of Schedule 3, means I mean to say they are specifically asking you to treat it as exempt supply. It means this transaction will also attract reversal. Now, I'll just take you to the actual section 17.3 because there is one more item. Yes, it is this. So, for the purpose of this subsection, expression value of exempt supply will not include activities or transactions specified in Schedule 3 because it is no supply, so it cannot be exempt supply. However, they want to include two transactions. Actually, now the third one is also added, but it is not given here. So they want to include few transactions of Schedule 3 in this exempt supply list. What are they? First, where the value of activities or transactions are specified in para 5, which is sale of land or completed building, and where the value of such activities or transactions as may be prescribed in clause 8 of para 8. What is clause A of para 8? It is where you have imported certain goods, your goods are lying in the custom bonded warehouse, and while they are in the custom bonded warehouse, you have sold it. So it is the bonded warehouse goods which are sold by you before its clearance. Those are para 8A supplies. So these are the two supplies from Schedule 3 which are presently, even though no supply transactions, but covered or treated as exempt supplies only for the limited purpose of this 17.2 reversal. Then you have 17.4, which is applicable to banking companies, NBFCs. Now you all know that a banking company, the P&L of banking company, if you see, the major revenue of a banking company is from interest, is from discounting of bills of exchange. And you all remember in exempt supply list, this is an exempt supply. However, nowadays, the modern banking, besides this traditional item of interest, is now having plethora of different items because it is today supplying so many other services. You have credit card, debit card services, you have the locker service, you have now those demat account service, you have the credit card service, you have the what you say, foreign exchange transaction service, you are given the letter of credit service. So many other services are given by the banks which are taxable. So today a bank's P&L is made up of both taxable as well as exempt supplies. Now, for such banks and NBFCs, the law has given two options. First option is to follow section 17.2 and rule 42-43, which we are going to discuss now after this, where you are every month required to do a calculation, find out the proportionate ITC, which is applicable or attributable to exempt supplies, and reverse it. So every month you do proportionate reversal, first option. Or a simplified option. Now this is actually the main option because first one is applicable to everyone. This is the main option given to banks, that instead of going for one-to-one calculation, which others are going to do, you can make an ad hoc reversal of 50% of eligible ITC. So already those ITCs which are not eligible, you will reverse fully because they are not eligible. But out of the eligible ITC, you will ad hoc reverse 50%. This is what is the main option. Now, balance will be reverse in GSTR 3B. So you can avail 50%. So you reverse the balance 50%. Importantly, this 50% restriction will not apply. When it will not apply? When you have purchased something from your own branch, which is registered under the same PAN, but having a different GST number because that has been registered separately. So generally, let us say you are talking about SBI Bank. SBI Bank within the same city, forget about state only, within the same city will have multiple branches, obviously in the state and entire country. Now, these all branches generally take a separate GST number, though they all fall in the same PAN. So we call them as distinct person. Now, if one SBI branch gives something to another SBI branch, the receiving SBI branch will get the full credit, and this 50% reversal will not apply. So where this 50% reversal does not apply is when you are buying something from your distinct person. Most important, this option is annual. So every year at the start, you are given a choice whether you want to go for actual reversal or you want to go for ad hoc reversal. Whatever option you select, that option you follow for the whole year. It cannot be changed in between. Let me see, there are a few chats. Siddharth is saying 1% of transaction. Yes, Siddharth, you're right. That 1% rule is applicable for the securities. So when we are saying that these security transactions are deemed to be exempt supply, what is the value taken? The value taken for this is 1%. We'll come to that value part later. So you are correct, Siddharth. What else is there? Sir, eligible means 50% of common credit and ITs. No. Eligible means other than 17.5. So there are certain block credits. Those are ineligible credits. They are anyways fully reversible. Other than that, all credits, whether common or whether specific, that is where you will see that is the difference between option 1, option 2. In option 1, you have to segregate between common, specific, then specific applicable to taxable, specific applicable to exempt. Here, all eligible credit, whether specific, whether common, club it, do 50%. That is what is the point, Siddharth. Now, how to do this reversal? So, for inputs and input services, you have rule 42. So, what does rule 42 says? Let us say we are taking your P&L for the year. Now, in the P&L on the debit side, you have all the expenses for which ITC you have taken. So, those expenses from the P&L debit side for which you have taken ITC, that total of ITC is your total T. So, T represents the ITC on all inputs, input services. So, simply P&L debit side, you see all input services. The total of the ITC of that is called as T. Now, from that, you have to minus, subtract what? T1, which is ITC, which is applicable exclusively for non-business activities. Second, T2, ITC, which is exclusively for exempt supplies. T3, where your ITC is already restricted under 17.5. T4, this also you have to subtract, where your ITC is exclusively for the taxable supplies. So these 4 ITCs you subtract. After subtracting these 4 ITCs, what is left is C2, which is your common credit. So common credit is total ITC of all items minus non-business, minus exclusively for exempt, minus exclusively for taxable, and minus 17.5 block. Remaining is your common ITC, which is now called as C2. Now for this common ITC, apply this formula. Multiply this C2, that is common ITC, by exempt turnover and divided by total turnover. So E represents exempt turnover, F represents total turnover. This you do month on month, that is for each tax period. Now, this amount what you get is called as D1. Now, find out D2 also. What is D2 dealing with? D2 is dealing with those supplies where you have used your goods partly for business and partly for non-business. So for them also you have to do proportionate reversal for as per 17.1. So for that they have given ad hoc 5%. So out of common ITC C2, 5% is assumed for the non-business portion. Now, what is the eligible ITC out of the common? So out of the common, whatever is the balance means now common was C2 after removing T1, T2, T3, T4. After removing those four, we had C2, which was called as common credit. From this common credit, you subtract D1 and D2. D1 was applicable for the exempt supply. D2 was applicable for the non-business supply. You remove it from C2. The balance of C2, that is the balance of common credit, is now what is eligible. So this is your eligible ITC, common ITC, which is eligible. And these two are non-eligible. Now, what is your total eligible ITC? One is this common portion, which you have just calculated. They have called it as C3 and plus T4. What was T4? T4 was your credit, which is exclusively applicable to taxable. We had for the time being subtracted it because that is allowed full. So now take that T4, add it to this proportionate C3, which you just calculated. This total is available and the balance you have to reverse this. Now, this calculation which you have done, the first clarification given is you do this calculation tax wise. So do it separately for the CGST credit, SGST, IGST, UPGST. Secondly, you did this working for every month. Now do this for the whole year again. So for the whole year, you make this working again. And if the per month working, whatever you did, and when you are doing the same working total, if there is any difference, you have to reverse further, do that reversal. If extra reversal has happened, you claim back the credit. So this is what is provided, right? Now, they have clarified certain things. Exempt supply will include what? Reverse charge transaction and even transaction of securities. It will also include Schedule 3, but in Schedule 3, it will include only two transactions. One is sale of land and completed building. And secondly, the sale of goods which are warehouse in the custom warehouse and they are not yet cleared for home consumption. Thirdly, what will not be included in exempt supply is if you are receiving any interest discount. So you can see generally in your books of proprietor, you have this also as a common P&L credit item where the proprietor is receiving interest either on saving bank account or FD. So that interest is exempt, but you will not consider it as exempt for the purpose of this reversal. And one is the outbound transportation of goods by vessel. Fine. Now, what is aggregate turnover? Aggregate value of exempt supplies and total turnover exclude the taxes. This is what we already know, that when you are calculating these supplies, whether exempt or total, you will not include any tax portion in the supplies. It means the value of all supplies for this particular purpose of calculation, whether value of exempt supply or value of taxable supplies, they have to be taken excluding the tax component. And last, what Siddharth was mentioning, that when we have to take the value of exempt supplies, we include value of land building. Which value of land building has to be taken? You have to take the stamp duty value. And when you have to include the value of security transactions, what value you have to take? Presumption. What is a presumption? That the life of capital assets is only 5 years. Please remember, students, this is a presumption. Actually, the life may be more or less. That is okay. Law presumes the life is how much? The life is 5 years. Now, what is the purpose of this? Here, we have to make calculation of proportionate ITC. How do we make calculation of proportionate ITC? Now, this ITC, which is belonging to common capital goods, divided by 60. How 60 or what is this 60? We are assuming the life of capital goods as 5 years. Every year you have 12 months. So total life of your goods is 60 months. Now, whatever is the ITC of these capital goods which are common means used for both taxable as well as exempt, divided by 60 so that you get the proportionate per month credit of this capital goods. Let us call it as TM. So TM represents the per month ITC of these common capital goods. Now, for this TM, how did you calculate this TM? I've already explained. TC, that is a credit upon 60. Now for this, you will compute the reversal. Now here, they have made one more calculation, TE. What is this TE? TE is total of TM of all capital goods which are common. So TM represented one capital goods per month ITC which is common. Similarly, you may have 2, 3, 4, 5, 6 capital goods which are common. Find out the TM of all and add all the TM, that is TE. So TE represents the per month ITC of those capital goods, all those capital goods which are common. Now apply the formula. What is this formula? E upon F. What is E? Value of exempt supply. F is value of taxable supply, right? Sorry, TE is the proportion amount that you get by multiplying E upon F into TR. TR is the total of TM. So TM is per month ITC of one capital goods which is common. Add such per month ITC of all common capital goods, that is TR. TR multiplied by E upon F is TE. So TE represents the ITC which is proportionately applicable to exempt supplies. This is what you have to reverse. So TE is the portion which you will reverse. Now this TM which you are calculating for the capital goods, how you will calculate? By taking the life of the capital goods as 5 years. Then TE is to be computed separately for all taxes CSI. Exempt supply will include reverse charge supplies and transaction in securities. Exempt supply will exclude Schedule 3, but they will include land building sale and warehouse goods sale. They will exclude interest. They will exclude outbound transportation of goods. So all these points are common with Rule 42. So 42, 43, these are common points. Is this clear to all students? Any questions? Debrata beta. See, simple example of Rule 43 is I have a machine. That machine is used to produce both taxable goods also, exempt goods also, because a machine produces everything. Now the ITC of that machine is, let us say, 20 crores, or for that matter, let us say 60 crores. Total ITC of that machine. I divide this by 60 months because the life of a machine is 5 years, which is equivalent to 60 months. So 60 crores is the ITC of this month divided by 60 months. So 1 month ITC is 1 crore. Now this is called as TM. Let us say I have this only machine, which is the common machine. So this 1 crore ITC is now applicable for 1 month, multiplied by the value of exempt supply divided by the value of total supply. Total means exempt plus taxable. Let us say this comes to 40 lakhs. So 40 lakhs becomes the amount of ITC of this machine which I have to proportionately reverse. Okay, Debrata beta. Fine, students. Excellent. So before now proceeding further, we'll take a break, the 15 minutes break, and we will come back and go back to the remaining provisions. Devrata is asking it happens in GSTR 1 or 3B, but it happens in 3B. In 3B, you reverse these ITC, the proportionate exempt ITC. Fine, beta? Okay. So we take our 15 minutes break now and we resume at 7:45. Fine. Should we take it forward? So I have a question. What are the consequences if rule 3 is not followed? Validity if I bought 3 number of AC, then shall I claim ITC for 60 months? See, but first thing, understand, you don't have to claim ITC in 60 months. ITC claim is immediate. So once you bring the AC, you get ITC immediately. Now, if you are using the AC in such a manner where your output is partly taxable and partly exempt, then AC, which is a common item, which is used for the entire business, and your outward includes taxable and exempt both, you will have to proportionately reverse the ITC of this AC in next 60 months. So availment is not in 60 months. Availment is immediate. So entire ITC credit I take immediately in the first month when the ITC is purchased. Then every month I do proportionate reversal. Now you are asking, what if somebody does not do this reversal? What is the consequence? The consequence is, then whenever the department will catch you either at the time of audit or at the time of assessment, there will be consequences in the form of interest penalty. Is this clear? Yes, beta. Am I clear? Okay, great. So students, we move on to the third part, which is a very interesting part, which is called as the blocked ITC under section 17(5). Now, what is all covered in blocked ITC under section 17(5)? So first is motor vehicle. MV is motor vehicle. Now, when we come to motor vehicle, you have to first understand one thing. Here, the blocked ITC is only for passenger vehicles, not for goods vehicle. If it is goods vehicle, then there is no problem with the ITC. ITC is always fully allowed. So first, whether it is a goods vehicle or a passenger vehicle, you check that. If it is goods vehicle, credit is always allowed. If it is passenger vehicle, then you have to check whether the passenger vehicle is of more than 13-seater. If yes, credit is always allowed. If the passenger vehicle is up to 13-seater, then credit will be allowed only if it is used in these 3 purposes. Otherwise, the credit is blocked. So, I repeat, motor vehicle, goods transport vehicle, passenger transport vehicle. Goods transport vehicle, fully allowed. Passenger transport vehicle, 2 categories, above 13-seater, up to 13-seater. Above 13-seater, fully allowed. Up to 13-seater, 2 categories. Whether that vehicle is used for making one of these 3 supplies or not. If it is used for making one of these 3 supplies, fully allowed. But if it is not used for making one of these 3 supplies, but it is used in the business for traveling of directors or for employees, but not for any of these 3 purposes, then credit is blocked. Now, what are these 3 purposes where if the vehicle is used, credit will be allowed? One, you are in the business of supplying the motor vehicle, so you are a dealer. Second, you are in the business of touring or transport of passengers, where you are using your vehicle for providing the passenger transport service. Or third, you are running a motor driving school, where the vehicle is used as you would have joined, if at any time you have joined any motor driving school, you are made to sit in the vehicle where the tutor or the trainer also sits, and you drive the vehicle for practicing how to drive the vehicle. So when you go to such motor driving schools, the vehicle which is used for teaching you the driving, that is eligible. So a vehicle below 13-seater or up to 13-seater capacity and which is used in one of these 3 scenarios is eligible. But where the vehicle is bought, even though it is bought in the business name, by giving business GST, and it is used in business only, but for what purpose? For traveling of the directors, owners, partners, or even employees, credit is not allowed. Fine. Similarly, when we come to ships or aeroplanes like helicopters, private jets, which many big businesses buy, same rule. If it is for goods transport, fully allowed. If it is for passenger transport and it is used for one of these purposes, it is allowed. If it is used for traveling of the directors or the owners, it will be blocked. What are these purposes? First, you are in the business of making supplies of such vessels, aircraft. That is, you are in business of selling these vessels or aircrafts, or you are in the business of transporting, like you're running the your Indigo, you are Air India. That is, you are in the business of air transport or by ship. Or third, you are teaching them how to either run that vessel or fly that aircraft. So we are in the business of teaching driving. Then the credit of these vessels, aircrafts, in these cases is allowed. In other cases, it is blocked. Then comes services of general insurance, servicing, repairing, maintenance, and it is for what? It is for either a motor vehicle or either it is for a vessel or an aircraft. So when you buy these motor vehicles, vessels, aircraft, regularly you spend on this. When you are spending on one of these services, what is the rule? The rule is simple. No need to read what is given here. The rule is simple. Where the credit is allowed of the motor vehicle, the credit of all these services of that motor vehicle is allowed. But where the credit is disallowed or blocked of the motor vehicle, the expenses on these services for that motor vehicle is also blocked. I hope this is clear. So the rule for these services is straightforward. Credit allowed for the vehicle, credit allowed for the services of that vehicle. Credit allowed for the vessel's aircraft, credit allowed for the services for that vessel aircraft. Is this fine? Is this clear? Great. Now we come to the other category. What is this other category? Now, instead of buying this motor vehicle or vessel's aircraft, you are taking the motor vehicle on lease or rent or hire. So see, one model is you buy, other model is you take it on rent. Now, when you take it on rent, whether the credit of that rent will be allowed, answer is same. Same means what? If the credit of motor vehicle is allowed on its purchase, then instead of purchasing, if you take the vehicle on lease rent, the credit of that lease rent is allowed. If the credit of the motor vehicle is blocked on its purchase, again motor vehicle means vessel, aircraft also. If on purchase the credit is blocked, then for the same motor vehicle, vessel, aircraft, if you take it on lease hire, the credit of that rent lease hire will also be blocked. So answer is simple. You have to only understand this. So if you understand this, you will come to know when the credit for that motor vehicle vessel will be allowed. Whenever the credit for purchase of motor vehicle vessel will be allowed, the credit for its services or the credit for renting leasing will be allowed. Where the credit for the motor vehicle or vessel aircraft is blocked, the credit for its leasing, renting, or the credit for all these services of that particular motor vehicle or aircraft is also blocked. Fine, students? Simple? Great. Now, next is food beverages, outdoor catering, health, beauty treatment, all these services which are generally I'm saying, are provided to employees as perquisites. So you would have studied salary chapter in income tax, where you add all these facilities as the perquisite income of the employee. So employer has taken health insurance, life insurance, or employer is providing any type of perquisites in the form of free food, etc. So when employer is incurring expenses on this, the employer is paying GST on many of these expenses. Now, whether the employer will get ITC of the GST paid on these expenses, the answer is 1. When is ITC available on all these expenses? When you are engaged in the business of providing these as your outward supplies. So your business is running a restaurant or outdoor catering or running a beauty parlor or a gym, or you are yourself providing outward insurance service. So when your outward is of same line of business, and for that you have purchased the inward, the credit is allowed first. Or when you are not in the same outward business, but the second possibility is you are providing this to your employees as, pay attention, as a obligation under some law. So Factories Act has made it obligatory, or within your state there is some specific labor law which has made it obligatory. And under that obligation, you are providing these facility services to your employee, then also the credit is allowed. If you are spending these expenses on employee without there being any obligation, then the credit will be blocked. So this is where the credit is blocked. Further, membership of club, health and fitness center, credit is available. However, where you are using it for employees and there is no statutory obligation, the credit will be blocked. But where there is statutory obligation, credit is allowed. Similarly, where travel benefits is given to employees who are going on vacation, where it is a statutory obligation, credit will be allowed, otherwise it will be blocked. Where inward supplies are made by NRTP, credit is blocked. Exception is where NRTP is bringing goods along with him, that is importing the goods. Credit is allowed. Otherwise, all inward supplies to NRTP, credit is blocked. Most important, where tax has been paid under section 74. Now there are two sections, 73, 74. Now they are replaced by 74A, but for your exams, it is 73, 74. In two cases, the department takes an action. What is the difference? Department takes action under 74 whenever there is some fraud, whenever there is some type of misstatement, or there is some fraudulent intention at your end, and because of that you have short paid or not paid the tax. In such cases, the department does the recovery under 74. But in normal cases where your tax payment was not done only because of some error, mistake, without any fraudulent intention of tax evasion, then the recovery is done under 73. Now, the point is, where the recovery is done under 74, that is, the supplier had fraudulently tried to evade tax. In such cases, when the supplier is caught and the tax is paid by the supplier, but it is paid because of section 74 action, then the ITC of such tax paid by the supplier is not eligible to the recipient. So where it was a fraudulent case, because of which tax payment was done by supplier, the ITC will be blocked to the recipient. In other cases, the recipient will be eligible to get the ITC. Fine, students? Then we come to some more services relating to blockage. Now this is works contract service. Now in this category, there are two types of service. One, you have hired a works contractor who does the construction for you. Second, you are doing the construction yourself. How? By purchasing all the inward supplies like bricks, steel, cement, appointing the different types of workers who will do the construction of immobile property. Now here, firstly, when you are doing any such construction service, either through a works contractor, then the credit of both these services is allowed. One, where you yourself are works contractor. That is, your outward supply is also construction. And for giving that outward supply of construction, you have taken the inward supply of construction either from a works contractor or bought these items. So when you are giving the same outward supply, you will be eligible for the inward supply credit, then these two blocking will not be applicable. First exception. Second, I am not a works contractor. I am doing this construction for my own use, like I want to construct a factory which I am going to run. In such cases, what will happen? Then they say check whether what you are constructing will be capitalized or is a revenue item. What you are constructing, if it is a revenue item, credit is allowed. If it is capitalized, then again there is a problem. So first, when credit is allowed for both these services, one, where your outward service is works contract. Two, when your outward service is not works contract, you are doing it for yourself, but it is not going to be capitalized in books. Three, where it is going to be capitalized, but it is plant and machinery. So what you are constructing is for your own self, and that is going to be capitalized in books, but it is plant and machinery. Correct? Now, when it will be blocked, that is the last scenario. You are not a works contractor, that is, you are doing that construction for yourself. It is going to be capitalized in your books, and it is not plant and machine. So it is a factory building, it is an office building, it is any such civil structure which will be capitalized, but it is not fitting in the definition of plant and machinery. Then this credit is blocked. Further, what all things are blocked under 17.5? Inward supplies from composition dealer. A composition dealer, both sides is blocked. Neither his outward supply, that is inward to you, is eligible for ITC for you. Neither the composition dealer himself is eligible for any ITC. Second, where goods are lost, stolen, or destroyed, or you are writing off them in your books, or you are disposing them, that is giving away by way of gift or free samples, you are not eligible to take ITC. Next, goods or services which you are using for CSR. So we all know CSR provisions under Companies Act. So where you are buying something and that is part of your CSR activity, the credit is not allowed. And lastly, where it is for your personal consumption, not for business, obviously the credit will not be allowed. Fine. Here they have given the other clearance, like all the full forms are given. And here, what construction means, what plant and machinery means, etc. That is different. So this is all block credit. Now we come to section 18, which is dealing with credit in some special circumstances. Now it has two aspects. One, when they are allowing you credit in special cases. Two, when they are asking you to reverse credit in special cases. Let us understand both. First scenario of section 18 is, pay attention. You are an unregistered person and now you are taking registration compulsorily. Why compulsorily? Because your turnover crossed the limit or you are fitting in section 24 scenario. Two, you are unregistered person and you are taking registration but voluntarily. When voluntarily you are not crossing the limit, you are doing it by yourself. Three, pay attention. You are already registered, but you are a composition dealer. Now you are changing to a regular dealer. Four, you are already registered, but you were in exempt supply. Now you are getting into taxable supply. So in these four scenarios, credit is allowed to you. And after this, we'll discuss exactly the reverse of this when the available credit has to be reversed. But we'll go to that later. First, when credit will be allowed. Now, firstly, understand in all those four scenarios, presently, you are not availing credit. So let us say right now I'm unregistered person. Today I have purchased 1,000 pieces of my goods which I am dealing in. Let us say I'm dealing in ready-made garments. So I have purchased from the wholesaler 1,000 pieces of the ready-made garment items. But since I am unregistered person, I cannot take credit of whatever GST that wholesaler has charged to me. Now I'm selling these garments every day. Out of 1,000, I have sold 800. Now, when I have sold 800, I reach the threshold limit required for registration. Now, my limit of registration has crossed. So now I become liable for registration compulsory. On this date, when I'm liable for registration, I have 200 units of this garment purchase in my stock. Now, when I will be selling these 200 units further, since now I have crossed the threshold limit of registration and since I have taken the registration, I will be required to pay tax on this 200. So out of the 1000 purchases, 800 I sold as unregistered person. I did not pay any tax on the outward. But this remaining 200, when I will sell from tomorrow, I have to pay tax. But when I purchased this entire 1000, I was unregistered, so I did not get credit of this entire 1000. But now, when I will be selling the balance 200, I am registered and I am going to pay tax on the outward of that 200. So I should get the credit of this 200 purchase. But how I'll get credit of this 200 purchase? As per section 18. I could not get earlier as per section 16 when I made purchase of this entire 1000 because at that time I did not satisfy the first eligibility criteria that I was not registered. So I did not get the credit then. So I will get the credit now, but under section 18. So what does section 18 covers? First two cases, I am unregistered, but now I'm getting compulsorily registered. I'm unregistered, I'm getting voluntarily registered. Whatever is in my stock on this date, when I'm converting from unregistered to register, section 18 says take the credit. Fine. Now the other two cases. What are the other two cases? I'm already registered, but registered as a composition dealer. You already know, and we just discussed a few minutes back, as a composition dealer, I'm not allowed to take credit of my purchases. But today, I want to convert to regular. Why? Because my composition threshold is crossing, 1.5 CR threshold is crossing. So I become regular. Or I engage in any such transactions like interstate supply, which I was not supposed to do. So anyways, now my composition status will be cancelled. In any case scenario, I am converting from composition to regular. Same example, I had purchased 1000 units from wholesaler. I did not get any credit, even though he charged GST to me. I did not get credit because I'm a composition dealer. I'm not eligible for credit. But if I'm converting to regular dealer, from tomorrow, I have to pay full tax on this balance items. On this, I will be getting the ITC for whatever is balance in my stock today as per section 8. That is scenario 3. Similarly, scenario 4, my outward is exempt. Let us say I'm buying some raw material, manufacturing final product is exempt. So whatever raw material I buy, no ITC allowed. But today, government has come up with an amendment whereby they have removed exemption from my goods. So from tomorrow, my final product is becoming taxable. Whatever raw material stock I am having today, I did not take ITC at the time of purchase because since my outward was exempt, inward purchase, we all studied in section 17.2, credit is not allowed. But now from tomorrow, since my outward is getting taxable, so whatever is there in my stock, either of the raw material or of WIP or of finished goods, which I'm going to sell from tomorrow onwards as taxable, I will be getting the ITC through section 18. So first part of section 18 in these first four scenarios, 2, I am unregistered, I am converting to registered. Another 2, I am already registered, but I am converting from composition to regular, or I am converting from exempt to taxable. In these 4 scenarios, I will be taking ITC. This is what section 18 provides. However, there are some conditions, there are some pointers to be noted. What are those pointers? In the first 2 scenario where I'm unregistered and I'm converting to registered, I am getting ITC only of the stock of goods which is lying, or you can say inputs which is lying. In the other 2 cases where I am already registered but converting from composition to regular or from exempt to taxable, I am allowed ITC of all stock of inputs, plus also if I have any machinery or capital goods in my stock. So for the second 2 cases where I'm already registered and converting from composition to regular or converting from exempt to taxable, I am allowed ITC even of capital goods. Very important. Fine. So see, these are the 4 case scenarios which I just explained. Now, what it says in the first 2 scenario, their first 2 scenarios, composition to regular and exempt to taxable. They are saying you are entitled to credit on inputs held in stock, again inputs which are semi-finished goods, or inputs in finished goods. So all these are inputs. Then you are also allowed credit for the capital goods. Now for this, again that 5-year rule applies. So we saw that the life of our capital goods under GST is assumed to be 5 years. Now when we say 5 years, it also means 60 months. This we used in our previous calculation. But if I have to go quarter wise, pay attention, 5 years, every year 4 quarters. So total quarters are 20, correct? Now pay attention. When total quarters are 20, if I have credit of rupees 100 and I have to divide it in 20 quarters. So every quarter, how much credit comes? It comes to 5. That is, it is 5%. So out of total credit, pay attention, total credit is 100 divided by 20 quarters, every quarter's credit. If I'm calculating quarter wise, my credit per quarter is roughly 5% of the total credit. Now, when I'm taking credit, why? Because I'm converting from composition to regular or from exempt to taxable. In that particular case, the requirement is, let us say I've used these capital assets already. I'm using this capital asset for exempt goods or as 3 quarters. So 3 quarters means per quarter 5%, 5%, 5%, total 15%. I have to reverse. In other words, I can take 85% of the credit. Today when I'm taking credit, I will take 85% of the credit because 15 I have to forego. Why? Because I have used this capital asset for 3 quarters. So the proportionate per quarter credit is 5%. For 3 quarters, it comes to 15%. I will forego that. I will retain 85% or I will take 85%. Correct? But in the other 2 cases, when I'm converting from unregistered to registered, I will get credit only of inputs. I don't get credit of capital goods. ITC in all the above cases is to be availed within 1 year from the date of issue of invoice by the supplier. Fine. Conditions for availing, you have to file a declaration. So when you are converting in any of those 4 cases, after conversion, you have to file the declaration within 30 days. This declaration will also be accompanied or will be requiring CA certification. It may be of CA or a cost accountant. If the total claim of your credit, because now you are availing credit, if it is exceeding 2 lakhs, you'll have to take a CA certification about this. Now we come to similar 4 scenarios where it is happening opposite. So now they are saying you have to reverse the credit. What is this opposite? Presently, I am in regular category. Now I want to convert to composition. Now you can convert to composition after the end of the financial year. So let us say we are in March. From April, I want to convert to composition. Why? Because my turnover has fallen below the composition threshold. So from next year, I want to become composition. So right now I'm in regular category. I'm converting to composition. Second, my goods are taxable. But let us say today some exemption notification comes, which makes my goods exempt. So from tomorrow, my goods will be exempt. So now scenario is opposite. I'm converting from regular to composition. My goods which were taxable are becoming exempt. Or I was presently registered. Now I am surrendering or cancelling my registration. Now in all these cases, I had already availed ITC. And today I'm having something in my stock. It may be stock of my inputs, which are held as inputs or as semi-finished goods or as finished goods. Also, I would be having stock of capital goods. So whatever stock of inputs, capital goods I have to reverse the ITC. So for inputs, which are inputs, semi-finished goods or finished goods, I have to reverse the entire ITC. For capital goods, again, I have to go by that 5% per quarter formula, which we just studied. So I have taken the full ITC of these capital goods because I was eligible to take ITC. Let us say I've used these capital goods for 2.5 years. So 2.5 years means how many quarters? Per year 4, 2 years 8, half years more 2. So total 10 quarters. 10 quarters means 50%. So out of the total ITC which I have availed on these capital goods, 50% I will reverse because I have used these assets or these capital goods for 2.5 years. So for 2.5 years, 50% is the ITC which I can keep. Balance 50 I have to reverse. Now this reversal I can do either from the balance of ITC if I'm having, and if my balance of ITC is over, I will have to pay the tax in cash. So this is what is the point relating to the other way around. So in the first scenario, we were taking ITC. In this scenario, we are reversing ITC. Now we come to another special scenario. Now here in this scenario, my existing business, I am selling to you. Either it may be outright sale, one, or there is a merger, there is demerger, there is transfer of business. So in one of these scenarios, my business is now being taken over by somebody else. Now, when I'm transferring my business, whatever is the ITC balance with me, that also will be transferred. This is what the provision says, with a specific condition that along with my business, I should also transfer all my liabilities to the transferee, that is who is buying my business. If I transfer all my liabilities also along with my business, then whatever is my ITC balance, this ITC, I will be eligible to transfer. Now, if it is sale, amalgamation, merger, I will transfer the entire ITC. However, if it is demerger, in demerger, what happens? My one unit, I break up into small units, and 1-2 units I demerge or separate it from myself and give it to somebody. This is what is demerger. In demerger, I will not give away entire ITC. I will give away proportionate ITC. Now, proportion will be of what? Proportion will be of the value of the assets. So my company was of 1,000 crore asset value. Now in demerger, 400 crores I have given to the other entity. So the unit which I am demerging, the assets is of 4 crores. So whatever ITC balance I have, let us say I have ITC balance of 100 crores. 100 crores is total ITC balance divided by 1,000, which is the total asset, multiply by 400, which is the value of asset I am giving in demerger. This proportionate ITC I will transfer. Again, you require a CA or CMA certificate specifying or stating that all the above provisions have been properly complied with. And again, you will file the declaration in your portal whereby you are showing transfer of ITC to your transferee, and the transferee has to accept that on his portal. So all this happens on the portal. You file the declaration, the transferee, it will appear in the transferee will accept, and that ITC will get transferred from your ITC ledger to the transferee's ITC ledger. Then comes the next case scenario. What is this second or next case scenario? In this case scenario, it is appearing like demerger, but it is not demerger, because in demerger, you give away one of your units to somebody else. This will appear like demerger, but it is not exactly demerger. How? In this, what has happened? You are one business, but having multiple branches. Now, as on date, you were running all these branches under a single registration, which is allowed. So let us say I have one branch in Mumbai, one branch in Pune, one branch in Sambhajinagar, one branch in Nashik. All these 4 branches is in Maharashtra. I have one single registration where Mumbai is appearing as the principal place and the other 3 are appearing as addition place. Now, I want to take separate registration for these 4 branches. So Mumbai, I'm already having main. The other 3, I want to separate and take separate GST numbers, though all are under the same PAN because it is the same company, same business. Now, this is also allowed whereby I can split one single registration into multiple registrations. So all these now will become separate GSTINs and distinct persons under the same PAN. Now, when I do this, my original entity was single. So entire ITC is today appearing in my Bombay registration because it was the main registration. Now, if I am separating the other branches, I may even proportionately divide the ITC between the branches. Now, how I will proportionately divide the ITC between the branches? Same what we were doing in demerger. I will take the ratio of the value of assets which I have given to each branch. So again, my total assets consolidated of all four branches was 1000 crores. Now, when I'm separating these branches, Mumbai is having 500 crore asset, Nashik is having 100, the other one is having 200, the other one is having 200. So now I will distribute the ITC in this ratio, that is the ratio of asset. Again, I have to submit declaration. The declaration has to be furnished within 30 days. All the other points are similar. Then the transferee, that is each of my branches, will accept it on the portal, and then the credit will be transferred from my ledger to their ledger. This is section 18 relating to some special case scenarios. Now there is one more point in section 18 which is not appearing here. That is where I am transferring my capital asset or even plant or machinery. So let us say I purchased some capital asset, let us say plant and machinery only. After purchasing, I took the ITC, let us say the ITC was 100 crores. My asset value is of some 500 crores, ITC is of 100 crores. Simple example. I took the ITC. Now this machinery I am using in my business, I've used it for 2 years. After 2 years, I want to sell off this machine. I want to dispose of this machinery. Now, when I want to sell off or dispose of this machinery, what I have to do, section 18 says, I have to pay higher of the two amounts. What are higher of these two amounts? One, I have to find out proportionate ITC balance of this machine. Again, how I will find out? Same rule, assuming life is 5 years. Now, out of 5 years, I've used the machine for 2 years. So the balance life is 3 years. So total ITC availed was 100 crores divided by 5 multiplied by 3, which is balance. So how much it will come to? It will come to roughly 60 crores. So first value I have computed is balance proportionate ITC. Second thing which I will compute is, since I am selling this plant and machinery outside, there is some tax liability on this sale. So I'm computing some outward tax because I'm selling this plant and machinery outside. This tax liability, let us say, is coming to 72 crores. I have to pay higher of these two amounts. One, the proportionate ITC for the balance life. Two, the sale value GST on the sale of this asset. Whichever is higher is what I will be paying today. I hope this is clear to everyone, right? Now we come to an interesting and important part. And this, I would request everyone to pay full attention and prepare thoroughly, because this provision has become compulsory from April 2025. It was optional till 31st March. So it was there. It is not that it is added new. It was already there. But from 1st April, it has become compulsory. Now, what is this concept? This concept is what is called as ISD, Input Service Distributor. What is this ISD or Input Service Distributor? Sorry. Just a minute, students. Give me a minute. Now, what is this ISD? So basically, this concept is coming from the service tax era. Now in service tax, like how in GST we have central, we have one registration, which
Recording
is
in
for managing
progress.
all the units. Now in this particular case, common expenses are coming and sitting in this head office GST number, but head office may not have any outward supply because head office is only for management purpose. It is the corporate office. Now, what will be done of this ITC, which is coming and sitting in my head office account? This is where ISD provision comes into play. What does ISD provision says? You have already taken a registration for all your units and also the head office, fine. Now take a separate registration, a special registration for this head office again. So one is your regular registration, which we take for all units. Same thing you have done for your head office. Take one more special registration for head office called as ISD. It is a separate and a special registration. Special means it is very different from regular. The returns are different. All compliances are different. That is what we have to study now. Now, when you take a separate registration for this ISD, it becomes one more entity. So you already have registrations for all the units, all the branches, plus you already have one regular registration for the head office. Now you have one more special registration for the same head office by the name ISD. Now, when you are receiving any common inward service, all these examples which I gave, legal, marketing, software development, etc., you take the bill in the name of the ISD, giving the ISD special registration number. So whatever your vendors are charging GST to you, that will come and sit in the ISD registration. It will appear in the ISD registrations 2A to B. Now, every month, ISD registration will distribute this common credit to all the entities, all the branches, all the entities, all the branches. Now, this is what is the purpose of ISD registration. Understand the logic. This credit is common credit of common input services. When I'm saying common means what? The benefit of this service is taken by all the units. When I'm doing marketing, it is benefiting all my units. When I'm doing some legal service, doing means I'm taking some legal service, that legal is for all the branches, all are taking the benefit of this. Now, when all my units or branches have taken the benefit of my services, which I'm calling as common service, the ITC should also be given to all the units or all the branches. This is what is the logic and ideology of ISD. To do this distribution of common ITC to all the branches, we take a separate special registration called as the ISD. Now, every month, when my suppliers will be raising invoice for this common services on my ISD, the ISD will be receiving the ITC of these common input services. Most important, ISD can be only used for input services, not for inputs and capital goods. So whatever common input services I am getting, I will take it in the name, in the registration number of ISD. Now ISD's return, like our return, outward return is GSTR1 and our final return is GSTR3. ISD has only one return, GSTR6. For our purchase summary is appearing in GSTR2A and this new 2B. But for ISD, whatever suppliers are supplying to ISD, when suppliers are uploading their GSTR1, the credit of that is appearing in the same GSTR6A of ISD. So ISD has only one return, GSTR6, but before that it has GSTR6A where all the inward ITC is appearing. Now, what this ISD has to do, most important part, it has to divide this inward common ITC to all its units, all its branches. How it will divide, that is the most important question. First, in what ratio it will divide. So whatever credit this ISD has received, it will divide it between all the units, all the branches, taking the ratio of their turnover. So it will take the ratio of the turnover of all the branches, and in that ratio, it will divide the ITC to all the branches. Now in this, there is a possibility. What if the branch is a new branch and there is no turnover for that branch? Firstly, it is not a new branch, it is old branch, but there is no turnover because in this month that branch has not made any sales. They say take the past year's turnover. Second possibility, if it is a new branch, there is no past year, this is the first year, then they are saying you take the immediate past quarter's turnover. If it past quarter cannot also be taken, why? Because the branch has started in this month, then the law is silent. So what we are suggesting is take the current month's turnover and divide. So basically you have to take the turnover ratio. Now comes the most important and most interesting part. So you have taken the turnover ratio. Now pay attention to this practical part. I am the head office, I am the ISD situated in Delhi. You all are my branches situated in different parts. One of you is in Delhi, one of you is in Mumbai, Maharashtra, one of you is in Gujarat, one of you is in Karnataka, one of you is in Kolkata. So all of you are in different states, but one of you is in my same state of Delhi. Now, as an ISD, I have received the inward invoices from my vendors. The vendors have charged me CS if they are from my same state, or they have charged me I if they are from another state. So in my ITC, I have credit of C also, I have credit of S also, and I have credit of I also. I have to distribute these three credits. Now, firstly, I will distribute these three credits to whom? The answer is to those units who have got the benefit of this common input service. Now, if the service is common for all units, I will divide it to all. If the service is only giving benefit to 2 units, I will divide it to 2 units. If the service is such that the benefit is only to 1 unit, I'll give the entire ITC to that 1 unit. I hope this is clear. If it has to be given to more than 1 unit, ratio is of turnover I have already explained. Now the most important part. When I have to divide this ITC to all of you in this manner which I just explained, I have 1 unit which is in my same state, that is Delhi. All my remaining units are in different states. It may be Gujarat, it may be Karnataka, it may be Tamil Nadu, it may be Maharashtra, it may be West Bengal. What I do is, or what I have to do is, I have 3 credits, C, S, I. When I am distributing C and S, you are in my same state, I will give you the credit by the name CNS only. I also have the credit of I. When I'm giving the credit to you, you are in my same state, I'll give you the credit by the name I. In short, if you are in my same state, I will give you the credit by the same name in which I have got the credit. So if I've got the credit by the name C, S, or I will give you the credit in the same names. But where I'm giving these credit to branches outside my state, to the Gujarat branch, to the Mumbai branch, to the Tamil Nadu branch, to the West Bengal branch, I will distribute all the 3 credits by the name I. Most important point. Very relevant for exam. So 2 things very relevant. What ratio? Ratio of turnover. Whom to be given? If credit is utilized or if the input service is giving benefit to all, give to all. If it is giving benefit to 2, give to 2. If the benefit is to 1, give to 1. And third important point, by what name the credit would be transferred or distributed? First, if the branch is in the same state, credit is distributed by the same name in which I have the credit. C, credit given by C name, S, credit given by S name, I, credit given by I name. But where I am giving the credit to the branches who are outside my state, I will give all the 3 credits to them by the name I. All this I do by preparing invoice. Now, I may have received certain credits which are block credits, blocked under 17.5, which are ineligible, which are blocked. I have to distribute even those ineligible credits. The thing is, I will make 2 invoices for every branch. One for eligible credit, one for ineligible credit. So I have to make 2 separate invoices and say This is eligible credit, distributed. Ineligible credit, distributed. So I have to prepare two separate invoices and distribute both the credits to each of the branches to whom it is applicable. I will do all this and I will file my GSTR 6, which is my return. And in this return, I will give details of all these invoices or these distribution with all your details. When I file my GSTR 6, whatever I have distributed to you, that will now go to you and you will be eligible to take the credit. So when I file my GSTR 6, you will be eligible to take the credit on the basis of my GSTR 6 returns. This is what is all about the ISD. Now, some more points. Let me read it from here. ITC of input services distributed only amongst those recipients to whom the services are attributable. So as I said, if the service is for all, you will distribute to all. If it is for two, you will distribute to two. If it is for one, you will give it to one. Second, ITC is distributed amongst the operational units and in the ratio of turnover in the state of the recipient during the period to the aggregate turnover of all recipients during the period to whom input service being distributed is attributable. In short, you will distribute it in the ratio of turnover. Turnover how? Turnover of all the units to whom this is applicable. So in numerator, turnover of the unit to whom you have to distribute, denominator, turnover, which is total. Then relevant period is previous year or last quarter prior to the month of distribution. So which year's turnover you take? The turnover you have to take is of last financial year. But if the unit was not there in the last financial year, then the immediate last quarter. Distributed ITC should not exceed the ITC which is available. Logically, whatever ITC the ISD is having in a month, ISD cannot distribute more than that. So it has to strictly distribute ITC equal to the ITC it is having in its return. Next, if ISD has distributed excess credit to any recipient, now this will generally happen by mistake. Either you have taken wrong ratio or you have given it to wrong branch to whom the service was not available, still you gave it. So if you have given excess to any branch, you will recover it. How it will be recovered? It will be recovered from the recipient with interest as if it was tax not paid. It means technically whatever it is written in simple words, that branch will reverse the credit. And if the branch has utilized the credit, it will also pay interest. Next, how ISD will distribute its credit? ISD will issue an ISD invoice for distributing. It should be clearly indicated in the invoice that it is issued only for ISD purpose. So ISD invoice should mention specifically that this invoice is only for distributing ITC. It is not a regular invoice, it is ISD invoice. Second, ISD needs to issue a ISD credit note for reduction in credit if the distributed credit gets reduced for any reason. So let us say I took 100 ITC, I am the ISD and distributed 100 ITC. Tomorrow, if this 100 ITC of mine is reduced, why? Because my supplier gave me credit note and made the 190. So it has reduced my credit by 10. So this 10 I will reduce from all of you means in the ratio by giving you my credit note. So how I gave you the credit by giving my invoice, I can reduce the credit by giving you my credit. ITC available for distribution in a month is to be distributed in the same month. So whatever ITC is there in this month, I have to compulsorily distribute in this same month itself. And most important, I have to file my monthly GSTR 6, which is my return, by the end of the month, after the end of the month, within 13 days. So after the end of the month, 13 days is the total time which I am having for distributing my ITC. Now coming to the last part in ITC, that is utilization. Now what is this utilization? Now when I get ITC, what do I do of this ITC? I set off this ITC from my outward liability. That is the main purpose of ITC. As I mentioned at the start, we follow the VAT concept whereby I have to pay tax only on my value addition. But how do I do that? I find out my tax on the output. From that, I subtract the tax which I have got on my inputs, which I have paid on my inputs. This is how we achieve the value addition concept of GST. Now, whatever is my output tax of this month, again, my output tax may be of IGST, of CGST, or of HGST. I have to pay off these tax in the month. And for that, I can utilize the eligible ITC which I am having. Again, the eligible ITC will be of IGST, CGST, SGST. How I have to utilize? For this, the section read with the respective rules has given me a strict sequence. What it says, I should first start with ITC of IGST. So I have ITC of CGST also, SGST also, I cannot take them. I should first take ITC of IGST and set off my IGST liability from that. So I start with IGST ITC and also I use it for knocking off my IGST output liability. So IGST input starting used for knocking off IGST output. Correct? Okay, Ashokji. 1 second, I'm making you the host. Done, sir. Now, so I was saying, I have ITC of IGST. I will use it to pay my output liability of IGST first. Now, if after paying the IGST liability, I still have balance ITC of IGST, now I can use it for paying the liability of CGST or of SGST, which is my choice. This can be done in any order, in any proportion. I may use my entire IGST for C. I can use my entire IGST for S. I may divide it equally. I may divide 1/3, 2/3. Anyway, my choice. Only when the entire IGST ITC is nil, only then I can go to second step. So I have to compulsorily exhaust my IGST ITC first. And that also firstly against IGST liability and then against CNS in any sequence or ratio. Now, after exhausting my ITC of IGST, now I come to ITC of CGST. Again, I cannot go to ITC of SGST. I have to first take the ITC of CGST. In this, I will now first pay the CGST liability. So using my ITC of CGST, I have to first knock off my CGST liability. So I will set off this ITC of CGST against IGST liability first. Now let us say I also have my IGST liability balance. Why? Because here, when I use my ITC of IGST, I used it against my IGST liability, but my IGST liability was more, so IGST liability is balanced. When I come to CGST ITC, I will first knock off the CGST liability. Even though I have IGST liability, I will knock off for CGST liability. And then I will use the CGST ITC balance to knock off the IGST liability. After this, I come to the ITC of SGST. This I will use against the SGST liability. And after setting off the SGST liability, if I still have the ITC of SGST, I will use it against IGST. But this I can do only when I have completely utilized my CGST ITC, because in sequence, I have to first use CGST ITC. So I have completely exhausted my CGST ITC here. Then I came to SGST ITC, which I first knocked off SGST liability, and then the balance SGST ITC I will use to knock off my IGST liability, if any. Most important, CGST ITC cannot be utilized for SGST liability. Similarly, SGST ITC cannot be used for knocking off CGST liability. In short, S and C cannot be used for each other. This is what is the condition relating to utilization. Now let me come to some points which are there in your detailed notes, but not in the, let us recapitulate. So we just studied this, which was order of utilization, which is provided in the different sections and rules. Now we come to some restrictions on utilization of ITC. Now these restrictions are given in these sections. First is 86A. What does 86A deals with? 86A deals with a scenario where I have to use the amount which is available in my electronic credit ledger for making payment of my taxes, right? Now what it says, 86A sub-rule 2 says, I'm starting with sub-rule 2 first, that the commissioner or the officer authorized by the commissioner under sub-rule 1 may, upon being satisfied that the condition for disallowing the debit of credit ledger as above no longer exists, allow such debit. Means what? 86A is basically restricting me from using my ITC ledger for knocking off my output liability. So generally we use ITC ledger for knocking off the output liability, but 86A says that the commissioner may not allow me to use my ITC for knocking off my output liability. In other words, this rule indirectly says that my ITC ledger can be blocked. Now, in what cases my ITC ledger can be blocked? The simple answer is where the commissioner or the officer appointed by the commissioner feels or believes that I have taken my ITC fraudulently. They can block my ITC. Now, when it will be said that I have taken my ITC fraudulently? So first, the credit of input tax has been availed on the strength of invoices, debit notes, or any other documents issued by a registered person who has found to be non-existent or not conducting any business. So when will my ITC said to be fraudulent? Where I have purchased the goods services from such a person who is registered, but when the authorities tried to trace that person, he was not existent, or when they went to the business place of that person, they found that there was no business happening. So this is clear-cut a case of fraudulent ITC availment. Second, when my ITC will be said to be fraudulent? Where I have taken the ITC, but there is no receipt of goods or services. So it is I have taken bogus bill and taken the ITC without actual receipt of goods service. Next, the credit of ITC has been availed on the strength of tax invoice, debit note, or any other document under Rule 36 in respect of any supply, the tax charge in respect of which has not been paid to the government. So if my supplier is not paying the tax to the government, it is as good as a fraudulent ITC taken by me, and again my credit ledger can be blocked. Next scenario, registered person availing the credit of input tax has been found non-existent, non-conducting the business. The registered person availing any credit of input tax is not in possession of tax invoice. So when my inquiry is done, either I am found non-existent as per point C, or in point D, I am not having the bills. So simple point is, in all these case scenarios, what it appears is that I have taken ITC fraudulently. Whenever I do this, they can block my credit ledger, which in the words of the law is, they will not allow me to do any debit in my electronic credit ledger. In other words, they will block my credit ledger. Now, this blocking will be unblocked once I clear all the above conditions or all the above problems. Or second, this unblocking will happen after a period of 1 year. So 1 year is the maximum period up to which they can block my credit ledger. Second, 86B. So 86A was blocking my credit ledger, completely not allowing me to use it if I have taken the ITC fraudulent. Now 86B, according to me, is a strange condition because there is no logic. At least there was some logic of 86A. 86B says that I will allow you to use your credit only up to 99% of the total credit, of the total liability. It means you have to compulsorily pay your output liability at least 1% in cash. That is by the cash ledger. So what is the restriction put over here? The restriction put over here is that they will allow me to use my credit ledger only up to 99% of the tax liability which I have to pay in that month. Means, in other words, they are asking me that at least 1% of my tax liability has to be paid utilizing the cash ledger. Now, this restriction, as I said, has no logic. Here, they are nowhere saying that I have taken the credit fraudulently or there is some malpractices done by me or by my supplier. No such allegations are there. Simply, the law says that this is what they will do. I'm reading this. Notwithstanding anything contained in this rule, the registered person shall not use the amount available in the credit ledger to discharge his liability towards output tax in excess of 99% of such liability. So simply they are saying you can use your credit ledger up to 99% of the liability, balance 1% you should pay in cash. Further, what it says, in cases where the value of taxable supplies other than the exempt supplies and zero rated supply in a month exceeds 50 lakhs. So this they are doing for large taxpayers whose per month liability exceeds 50 lakhs. However, they have given some relaxation. So what they say, the said restrictions will not apply where the said person, that is you or the proprietor or karta of your business or any of your two partners, whole-time directors, members of managing committee of the association or board or trustees as the case may be, have paid more than 1 lakh as income tax. So if your income tax payment is more than 1 lakh in last 2 financial years, so it means they will consider you as genuine and the above restriction will not apply, then you can use 100% credit. Second, the registered person has received a refund of more than 1 lakh rupees in the preceding financial year. So under GST itself, we have taken refund of more than 1 lakh. So again, you are genuine. Third, the registered person has received a refund amount of more than 1 lakh. So both are refund, but under different clauses, clause 1 and clause 2. Fifth, the registered person has discharged his liability towards output tax through cash ledger for an amount which is in excess of 1% of the total output tax applied cumulatively up to the said month in the current financial. So in all these cases, they are saying that we will not apply this restriction. It means you can fully utilize your credit ledger. Further, this restriction will not be applicable to all these persons. Provided further that the commissioner or an officer authorized by him in this behalf may remove the said restriction after such verification and safeguards as he deems better. Yes, Debrata beta. In practice, people may not be doing this, but if they are not doing this, they receive notice from the department. So students, with this, we have completed the entire ITC with all these aspects, utilization, everything we have completed. So I hope you have understood this entire part. Please read this chapter thoroughly. This chapter is very, very, very important in exams. You have to understand all the provisions, even though they are slightly tricky, but kindly make note of all of them. Right? Shubhankar ji wants to say something.
Yes, yes, sir.
Yes, please.
Yes. Thank you so much, Vishal, sir. And
My
good evening, dear students. Today, our esteemed faculty, C. Vishal Podar, sir, has delivered such a detailed and insightful revision session on the topic input tax credit. The session was not only enriching in terms of the conceptual clarity, but also provided the practical aspects that will surely be the immense value to all the CA final aspirants present here. Input tax credit is just not only the chapter or a topic in the subject, but it is the backbone of the entire GST. And also score in this topic is one of the most crucial and scoring areas of the GST paper, that is IDT paper of the CA final, and carries the substantial weightage in the examination. Therefore, understanding it thoroughly is vital to ensure the overall success in the subject. Today's session was designed to be the value addition for each of you. It aimed to revise the core concepts covered the important provisions and also shed light on the practical aspects. As sir has given some practical examples, also related, also gave some practical insights in this session. So that was really helpful. The purpose is to ensure that no student feel underprepared when he face the questions from this section in the exam. Revision is the most important thing, but beyond that, I urge you to consistently practice the questions from ICAI study material, your mock test papers, the MTP booklet is given to you, revision test papers of the past attempts paper, and your past attempt question papers. So, so these were the points, and the most important thing which you need to, which is the most important concern for your exam, that there is one uh, amendment related to the cross charge, which is given at the end of your chapter. But the definition, there is a difference. Sorry, there is an amendment in the topic related to the input service provider, which is not applicable for the September examinations. So the students who are appearing in the September examination need not to panic about this. So this will not be applicable for them, and all the other things as taught and explained by the sir will be the area of the discussion, are the important area of the discussion. So with all these things, uh, thank you so much, sir, once again for your valuable time and efforts, and thank you to for all the students for their active participation. Thank you so
Thank you,
much.
sir. Thank you, everyone. Good night. Thank you. Yes, sir. Over from